7-Eleven is the world's largest convenience store chain. Despite that title, it has somewhat of a reputation problem, namely in the US, where it was founded.
I don't think I can buy anything here in good spirits, to be honest. It's not for me.
It always has that kind of dirty feel. You feel the floor is a little bit sticky. The lights are kind of dingy. There's hot dogs rotating under a hot light that's been probably there for most of the day.
Japanese parent company 7&i Holdings is facing pressure after disappointing financial results. Shares have fallen more than 18% in 2025. And in July, after a year of negotiations, Canadian retailer Alimentation Couche-Tard pulled back its $47 billion bid to acquire 7&i. Now the company is shifting its focus toward transformation, aiming to make its US 7-Elevens, where most of its revenue comes from, more like its Japanese stores, which have become something of a cultural phenomenon. The focus will be on the in-store experience. A key component of that is food, and its new first non-Japanese CEO is leading the charge.
Expect to see more of a Japanese style of the 7-Eleven start to flow through. They've got somebody who understands the U.S. market, so I think they've got a fair chance of improving the U.S. operations.
Founded in Irving, Texas in 1927, 7-Eleven pioneered the convenience store concept. It was an early adopter of the franchise model, kept long operating hours, and built brand awareness with iconic products like the Slurpee and Big Gulp. In 1973, a Japanese grocery store signed a franchise deal with 7-Eleven and opened its first stores in the country. Over the next 2 decades, the company acquired enough shares to become the majority owner of the American convenience store chain. 7&i was formed in 2005. Today, it's the largest convenience store chain in the US and the biggest retailer in the world by store count.
7-Eleven is obviously a global leader in the convenience store space. If you can improve the density, bring in more people, you'll be able to derive better margins. That's the backdrop to their expansion in the States.
Net income dropped about 17%, and nearly 450 underperforming stores were shut down in fiscal year 2024 in its North America market, which is majority the US. In first quarter 2025, both same-store sales and year-over-year traffic were down.
In the US, there's a degree to which 7-Eleven has rested on its laurels. It hasn't really invested and it hasn't evolved the proposition. I think they're now under pressure to do that because investors are clamoring for returns, and the US is one market where they can make inroads.
The company's weaker performance in the US can be traced back to a few unique challenges. 7&i has less control over its US businesses, as most are franchised.
Some franchisees won't agree with the changes, and that does make it more complicated to bring them along and to ensure that there is a degree of consistency in the changes that you want to make.
Competition is another. The US convenience store industry is highly fragmented. Not only has it consolidated substantially, but hyperlocal or regional chains like Wawa, Casey's, and Sheetz have built loyal followings by offering strong food options and customer service.
They were just very focused on expansion. Now, when you're focused on those things, you can generate pretty good growth. But what doesn't always happen is that you don't evolve the store concept and format in a way that's suited to changing consumer needs. And I think 7-Eleven fell into that trap.
The convenience store industry dynamics have also evolved over the years. Dollar stores have expanded into rural areas, and key categories have seen sales declines. At the same time, more and more consumers get their groceries delivered, undermining the convenience these chains used to offer. 7-Eleven is also dealing with the fallout from the failed mega merger with Alimentation Couche-Tard, the Circle K owner. ATD withdrew the multi-billion-dollar offer due to what it called a lack of engagement from 7&i's leadership, though the company disputes the claim.
The alternative is to wait for the company to try and achieve the potential that they're planning to do.
7-Eleven is working to streamline operations and strengthen its finances in preparation for a potential IPO in 2026. 7&i is planning to spin off the business, but stay on as a majority shareholder, which is part of why it's course-correcting in the meantime. The company has launched several transformation plans. The latest, from 2025, is focused on turning its stores into food destinations. Since 2019, it's been working on adding restaurants, building or renovating kitchens, modernizing food and beverage options, and accelerating digital and delivery. It owns 3 fast food chains: Laredo Taco Company, which it inherited from a Sunoco acquisition, Raise the Roost, a Southern-inspired chicken chain, and Speedy Cafe. It's been slowly adding some of these restaurants to its stores, as they've driven higher sales and traffic. The company plans to open 1,300 new food-focused stores in North America by 2030.
Having restaurants in some locations, it becomes a place that people come to as well. And then you get them in the store and you start buying other stuff. But having said that, there's costs involved with the restaurant. So it'll be interesting to see whether that works out.
In May 2025, Stephen Dacus became 7 & I's first non-Japanese CEO. Hailing from leadership roles at Walmart and several Japanese food-focused companies, Dacus has launched a plan to make the US stores more Japanese, starting with food. That includes its iconic egg salad sandwiches. Warabeya, the fresh food manufacturer that makes 7-Eleven Japan's ready-to-eat meals, is opening its 3rd US facility in 2026.
7-Eleven has sort of woken up and said, hey, actually, we just don't have the competitive advantage that we used to have. We need to change and evolve so that we can get customers back, we can increase spending, and it's probably something they should have done 5-10 years ago, but the second best time to start is now.
Renovating stores, adding kitchens, and improving product offerings are costly and time-consuming.
The food service is going to be gradual. We're seeing slightly better spend numbers, but we're not seeing the foot traffic improve. So that needs to be watched.
Between July 2022 and July 2025, 7-Eleven didn't see any sustained customer growth at its US stores, according to Indigari, which tracks credit and debit card data. Convenience stores like Casey's and Wawa have long offered quality food at decent prices. These rivals might play in different markets than 7-Eleven, but they've mastered one important segment in the US that 7 & I hasn't.
The US is a very, very intensely competitive market in food service, in convenience, in retail generally. For the convenience players, the battle is like, hey, you spend $10 with us every week. How can we get that to $15 and actually take away some of your share of wallet from other retailers?
Then there's the potential IPO. Going public would help 7 & I raise money by taking on more debt, capital that is needed to build more stores. But more importantly, to pay for all of its planned upgrades. And it would allow the company to go through a correction without dragging down the other parts of its business. But the IPO is not a sure bet, especially since Alimentation Couche-Tard withdrew its acquisition of 7 & I. A tough economic environment in North America could affect the decision too, according to Dacus.
This isn't the best kind of market to be reinventing in, although there is an opportunity for 7-Eleven there because it doesn't play. If it can find a point of differentiation, maybe healthier food, maybe different types of cuisine options, maybe stuff that people take out and can eat on the go or can take home for a meal. But I don't think investors are concerned that 7-Eleven is in trouble, because the fact is, it isn't in trouble. It's just a business that needs to refresh itself and to keep itself relevant. And that's what it's trying to do in the US.